Crypto feels dead again. That is the mood right now. Prices have been shaky and sentiment has been weak. And for a lot of people, it feels like the market has lost all momentum. But when markets feel the worst, that is usually when it becomes most important to stop reacting emotionally and start looking at what is actually happening. Because right now, the crypto market is being pulled in two directions at the same time. On one side, there is fear. As global markets have been dealing with major uncertainty tied to geopolitics and broader risk-off behavior. Reuters reported that global equity funds recently saw their biggest weekly outflows in 3 months, while money market funds kept attracting cash, showing that investors have been moving more defensively. On the other side, there is still demand. Reuters also reported that, despite recent volatility, investors still put about $1 billion into cryptocurrencies in the latest week covered by Bank of America's EPFR-based flow data. That tells you something important. Even while fear is high, some capital is still stepping in. So this video is not about hype. It is not about pretending everything is bullish, and it is not about calling an exact bottom. It is about understanding why crypto feels so bad right now, what the data is actually telling us, and how smart market participants usually behave in this kind of environment. First, let's talk about why the market feels so heavy. A big part of it is macro pressure. When investors get nervous about war, energy prices, central banks, or recession risk, they usually reduce exposure to assets they see as risky. Crypto is one of the first places where that pressure shows up. Reuters reported that recent global fund flows reflected investor caution ahead of central bank meetings and geopolitical tensions tied to the U.S.-Israeli conflict with Iran. That kind of backdrop matters because crypto does not trade in a vacuum. This is one of the biggest mistakes retail traders make. They look at a crypto chart and assume crypto is moving for crypto reasons only. A lot of the time, crypto is also reacting to the same forces affecting equities, yields, the dollar, oil, and overall risk appetite. That is why you can get a market where the long-term crypto story still looks alive, but price action still feels terrible in the short term. Now let's look at the second force hitting the market. Regulation. Reuters reported that Citi cut its 12-month price targets for both Bitcoin and Ethereum because U.S. crypto legislation has stalled. Their updated targets dropped to $112,000 for Bitcoin and $3,175 for Ether, down from earlier forecasts, because progress on the Clarity Act slowed and stablecoin-related disagreements reduced confidence in near-term regulatory catalysts. This matters for one simple reason. A lot of bullish crypto narratives depend on new pools of institutional demand, and institutional demand becomes easier when regulation becomes clearer. So when legislation stalls, markets start questioning how quickly the next big wave of adoption can happen. That does not automatically mean the long-term thesis is broken, but it does mean one of the biggest possible catalysts gets delayed. And when catalysts get delayed, price often gets weaker before it gets stronger. That is why the market can feel stuck. Now here is where it gets interesting. Even with all of that pressure, crypto has not simply collapsed into irrelevance. There are still signs of support. CoinDesk reported that spot Bitcoin ETF demand has remained an important driver, and Reuters' broader flow coverage showed fresh money still entering crypto products recently, even while investors were cautious overall. That creates a very important tension in the market. Retail sees fear and thinks the story is over. Professional investors see fear and start asking a different question. Is this weakness a warning sign? Or is it a discount? That is the key difference. Retail usually wants emotional certainty before buying. Smart money wants asymmetry. They do not need everyone to feel good. They need price to be attractive relative to risk. And that is why some of the biggest opportunities in any cycle show up when the headlines are confusing, sentiment is weak, and conviction is low. Now let's be clear. That does not mean smart money blindly buys every dip. This is another mistake people make. They hear institutions are buying and assume that means the market must immediately rip higher. That is not how it works. Professional capital often scales in slowly. It can buy over weeks or months. It can hedge. It can sit through volatility. Retail usually cannot. Retail wants instant validation. That is why so many people buy breakouts after the easy part of the move is already gone, and panic sell during the ugly middle when markets are chopping everyone up. So, what should people actually watch in this environment? Number 1, flows. If money keeps entering crypto products even while sentiment remains weak, that is worth paying attention to. Reuters reported about $1 billion flowed into cryptocurrencies in a recent week, and CoinDesk has also highlighted ETF demand as a stabilizing force during market stress. Number 2, regulation. If legislative progress improves, that could restore part of the institutional adoption narrative that has recently been questioned. Reuters specifically tied cities' lowered targets to stalled legislation, which shows how important policy remains for market expectations. Number 3, macro conditions. If broader markets remain defensive, crypto can struggle even if its internal fundamentals are not collapsing. Reuters' recent fund flow reporting showed investors moving into cash and away from riskier exposures during this geopolitical period. And number 4, sentiment itself. When everybody starts speaking as if crypto is finished, that does not prove a bottom is in. But it often tells you fear is becoming extreme. And extreme fear is usually where the best questions begin. Not, should I ape in right now? But, what assets are holding up best? What catalysts still matter? Where is real demand still showing up? And, if the next leg higher eventually comes, what will people wish they had been studying during the ugly phase? That is the mindset shift. The point is not to predict every candle. The point is to understand the environment. Right now, the environment looks like this. Macro uncertainty is real. Geopolitical risk is real. Regulatory delays are real. Price weakness is real. But institutional participation has not disappeared. Capital is still moving into crypto products. And that means the market is not dead. It is conflicted. That is a very different thing. A dead market is one where the story is gone, the liquidity is gone, and the interest is gone. A conflicted market is one where fear is high, narratives are mixed, and positioning becomes more important than emotion. That is where we are. So what is the biggest mistake retail makes here? It is overreacting. Either they go all in because they are desperate to catch the exact bottom, or they mentally check out because they assume nothing good can happen until price already looks healthy again. Both reactions are emotional. A better approach is simple. Slow down. Watch the data. Pay attention to flows. Pay attention to regulation. Pay attention to macro. And stop treating every red week like the end of crypto. If you study market cycles, one thing becomes obvious. Opportunity rarely feels comfortable when it first appears. It usually feels uncertain. It feels annoying. It feels early. And it feels hard to trust. That does not mean every dip is a gift. But it does mean fear alone is not a strategy. You need a framework. And the framework right now is this. Crypto is under pressure from bigger global forces. That pressure has weakened sentiment. Regulatory delays have reduced some of the optimism around near-term adoption. But money has not completely left the space. Institutional demand still matters. And if that demand survives while sentiment stays low, the market may be building a very different setup from what most retail traders assume. So, no, I am not saying the bottom is definitely in. And no, I am not saying the market is about to explode tomorrow. But what I'm saying is, when everyone is emotional, the edge comes from being analytical. When everyone is reacting, the edge comes from staying patient. And when everyone says crypto is dead, the smartest question is not, how do I get rich this week? It is, what is the market quietly telling me right now? That is the game. Not hype. Not panic. Positioning. If you want more videos breaking down what the data is actually saying in crypto, subscribe and follow along. Because in markets like this, clarity is worth more than confidence. Thanks for watching. Don't forget to check out the Telegram linked in bio.